Welcome to the weekly video update, where I'll go over the action in the market for the week of September 18th through the 22nd, and then we'll see how things are looking for the week of September 25th through the 29th. We have turned more negative. In fact, in the daily videos, we have switched more to a negative stance. We're also dealing with some support. Now, some support we've already broken. There's still some other support that we haven't broken yet, and we're wondering if that's going to come in and help some things get better. We are also in a weak seasonal time. Not only is September all of by itself weak, we're in a weak part of a weak month, and that's really dragging things lower. There were some negative things that came out this past week. The Fed decided not to raise interest rates, but the comments that were made after they made their announcement were not taken as positive, and we're just shifting more to a doom and gloom type of outlook right now. We're wondering if it's going to continue along those lines or if it's finally going to change at some point. Now, before I get started, please know I've been having some trouble with this. There is a PDF that's available in the description. If you watch these videos on Rumble, you're not having a problem. But for some reason, YouTube is coming in and deleting the link that I put there to the PDF. I've tried to contact them, but I haven't heard anything back yet. If you want a PDF of all the slides and charts that I use and you can't access it on YouTube and you still want it anyway, send me a comment or an email and I'll be happy to get that to you somehow, some way. I don't know what the problem is there. I do have a private Facebook group that you're welcome to join. So far, I'm pretty much the only one that posts anything there. And I'll go through the poll results here in just a moment, and I will be putting up a new poll after I post this video. Also, I keep a real close eye on YouTube comments. I had to go through this week and delete a whole bunch of them, the garbage ones that they're just crazy. Now, I do want to keep this open where if you want to say something, either you agree with something that I said or how I interpret things, or you disagree, that's fine. It's the garbage comments that the bots put on there, and they're just not good to deal with. And I also, as I mentioned, I do post these same videos on Rumble. Here is the link to the channel there. All right, let's go back and talk about what happened. So for the week, we were down 2.93%. That's a pretty significant move compared to what we've been doing lately. Volume, though, has slipped back to below average. We did go above average last week, but that was due to quadruple witching, and that kicked the overall average up. But now we're back down to below average. Our technicals are turning more negative. We are showing an oversold condition in the short term on the daily charts, and we're looking more negative and kind of oversold in the intermediate term. We're actually seeing some oversold indications here on the weekly charts that I'll go through. And it's about inflation and interest rates and what the Fed has been saying. And the market likes to create this rosy scenario that, oh, the Fed must be done. And then the market starts to go up. The Fed comes out, rains on that parade, and then the market goes down. But in the background, we're still looking okay. We're just going through a rough time right now. Now, that could always change into a full-blown downtrend. And the perma bears, they're just giddy right now as things are going down. But we're still looking okay longer term, and you'll see that as I'm going through the different charts here. Our trend is weakening. It's still positive, but that green line is just about ready to cross over the red line, and I'll show you that as well. So for the week, the Dow was down 1.9%, the NASDAQ down 3.6%. The S&P itself was down 2.9%, actually 2.93%. And the Russell was down 3.8%. That's one of the concerns right now. The small caps, they're hurt more by rising interest rates because these are smaller companies. They typically have to do a lot of borrowing. They might have to float some bonds out there. They're not as established as bigger companies. And so the interest rates can really affect them more. All right. So for the week, the major indices all had sizable declines. We were down across the board. The mega caps also, which have been leading the way in 2023, they led the declines lower, but we also saw more of a broad-based sell-off and broad-based declines. All of these sectors, all 11 of them for the S&P, they were down on the week. And rising interest rates are causing a lot of fears. That's really what's happening right now. And the Fed has been a little more hawkish with their comments. And speaking of that, Fed Chair Powell did come out and gave his press conference after the Fed made their announcement on Wednesday. And he said that they're going to proceed carefully, which is nice and ambiguous and really doesn't tell the market much of anything. And then other Fed officials came out later in the week and also made some more hawkish stances that maybe they're willing to raise interest rates. And that spooks the markets whenever that comes out. Rates were unchanged in the Bank of England and also the Hong Kong Monetary Authority. They left rates unchanged, as well as the Swiss National Bank and the Bank of Japan on Friday. They left rates unchanged. But you had Riksbank, which is in Sweden, and the Norges Bank, I think I'm saying that right, in Norway. They did increase their rates. And the United Auto Workers strike, it's still continuing, and that could have an impact on the economy. Here is a chart of the VIX. I go over this every day in the daily videos where we're starting to enter that time now where we might follow this blue line. And as this is going up, that means that fear is increasing, which also means stocks are going down. So we have been kind of following this along in 2023. We're wondering if that will continue. We might see a bit of a bounce if we get through this more weak season or weak period in September. But then are we going to continue falling, or are we going to break with what this average has been? This goes up until about the mid part of October. We're also keeping an eye on inflation. We're going to get another report coming out at the end of this upcoming week, the PCE prices, where if we compare this from 1966 to 1982, we should be in this phase now where inflation is coming down. The negative side is after that, we have seen historically a real pickup in inflation. Now, we don't know if it's going to happen just like this or not, but we have been following this kind of close, so we just want to use this as a guide. We're also keeping an eye on this from RenMac, and I got this chart on Twitter where they did some research, and they came out and said that if we get above 4.02% with the 10-year yield, that's when it starts posing a problem for stocks. Well, after Friday's session, we're at 4.44%. So we're in that category where the rise in interest rates is pressuring stock prices. Let's get into our poll results. Where the first question that I asked the latter part of September, which we're still in right now, it's historically weak. Do you feel this year will be the same? 75% said yes. And so far, that's what's happening. And then I forgot the question for this one. So I'm asking here, are we going to develop a positive trend based on where we were a week ago? Are we going to develop into a negative trend, or will we remain trendless? We're pretty much trendless right now, but we're starting to see a new trend develop. And it's kind of at the early stages. And as of right now, it looks like that trend is negative. And then if rates remain the same, do you feel that Chairman Powell's comments at the press conference, will they help stocks go higher? 25% said yes. 75% said they'll stay about the same. Well, actually, they went lower after that. They didn't like what he said. The FOMC is meeting this upcoming week. That's now passed. There's a 98% probability. It actually went up to 99% right before the meeting that rates will remain the same. Do you agree with this? And I should have done a better job of wording this question. I said, do you think that you feel the same as what the market is saying right now? If you don't like interest rates going up because things are more expensive, well, yeah, you're going to disagree with this. But it was pretty much split between 60 and 40 with what they think was going to happen. And that's how it played out, is that rates were unchanged. It was the comments afterwards that really kind of spooked the market and then led out the declines that we saw on Thursday and Friday. Then some Isabel Net blog charts, and I'm really cutting back on the charts that I go through. I try to just bring out those that I think are really helpful. This is a chart that I've shown. This will be the third weekly video where I've used this. This is the S&P 500 against its seasonal pattern. We're right about in here in September, where this is where we tend to see some weakness going into October during a pre-election year. But this is actually measuring from 1990 up to 2022, where we do see some strength going into the end of the year. We just have to see how long is this downturn going to last. This is a new one where Carson came out with looking at just pre-election years. And here we're in the yellow area. We came through July and August. Now we're starting to get into September. So we're right about in here where the green line is at. And then the orange area, this is what historically has happened, where we can see some problems. But then once we get through this, now they had this going into the latter part, middle to latter part of November, before we see things start to improve. So it could be a little bit bumpy, at least historically, that's what has happened. Now the market can do whatever it wants, but we use this again as a guide. Then we had the LEI that was released this past week. It's still below this red line here, even though it's coming back up. When we drop below this, that means there's a recession signal and that there's a warning. And so that kind of goes in the camp of, yes, we're going to go into a recession. But at the same time, we have a lot of other charts that the MBER, they're the official outfit that declares if we're in a recession or not. Those charts are still looking okay, and they haven't really rolled over, at least yet. So there's this back and forth between, are we going to go into a recession? Are we not? Are we going to have a soft landing, which means we're seeing economic slowdown without going into a recession, and then anywhere in between. And it's kind of take your pick. And it's been that way for over a year now as this debate has gone back and forth. We're still seeing earnings estimates looking pretty rosy going out. Now, this justifies prices actually going higher. Then FactSet had some interesting posts this past week where they say industry analysts project 19% increase in the S&P 500 price over the next 12 months. My goodness, a 19% increase looking out. So a year from now, they think that we'll be up 19%. Here is their projections here in the top part, and this is what's happening right now. Then this is also interesting. If you're aware of a thing called ESG, which is an acronym, and it's, if you know anything about it, you probably know that it's a bit controversial. And I would recommend that you try to learn about that. Now, if you want me to go more in depth of what ESG stands for and what it means, I would be happy to do a video on that. And I've done a lot of research on this, and some people think it's a really good thing. Other people think it's a really bad thing. And so you need to take all the facts as best you can and then reach your own conclusion. Well, that's been all the craze lately, but we're seeing a real drop off in this being mentioned in the earnings calls going back to 2020, which is kind of when this was first leashed upon the public as something. And just to kind of sum it up really quickly, they look at the economic, social, and governance scores instead of just looking at earnings. And a lot of longtime investors, you might have a problem with that, where you want to look at the earnings. You want to see earnings growth, where the ESG way of doing things doesn't necessarily look at the earnings. They look at how are they doing on a social level and a different score that is being projected. And some people think that's good, and some people think it's bad. All right, let's get into our charts here. We first look at the intraday daily chart. Each one of these bars is 10 minutes, where we were pretty much flat on Monday and Tuesday because it was leading up to the Fed. And then right here where you see this move down, that's when the Fed made their announcement. We tried to bounce back up. And then as Fed Chair Powell was giving his press conference, the market really didn't like that. We ended up gapping down quite a bit on Thursday. We didn't move all that much, but then we saw some weakness going into the close. And we're coming down here. We actually closed below the August 2022 high on Friday. We tried to go higher, tried to show a little bit of a bounce, but then we saw some more late day weakness. And then the daily pivot actually was acting as overhead resistance, and then boom. So this is doing some technical damage to the markets currently. So for the week, all of the different indexes that we follow were down. Going back to the beginning of the year, we have the NASDAQ 100 and the NASDAQ and the S&P, which are positive. The interesting thing to note here is the small caps have now gone negative since the beginning of 2023, and all of the indexes continue to be negative, going back to the all-time high set in early January 2022. Looking at the sectors, all of the sectors ended up being down, and I should have organized this a little different. The weakest is on the bottom with discretionary. Real estate's been having a lot of problems. That's been in a downtrend, but everything pretty much got hit. So this was more broad-based in scope. Then we look at the relative rotation graph, or RRG, and we're seeing energy really starting to go into the lead as far as what's strong. This is the +1+1 area showing what's the strongest. The areas that had been strong earlier in the year, communication, discretionary, and tech, they are showing some weakness now. They're still holding up okay, but this yellow means that they're getting weaker. And we are seeing a little bit of improvement in some of the other sectors, including the financial sector, which got hit last March. We're still wondering, is there going to be more banking information that comes out? So when we look at the sectors, some interesting ones that we haven't seen in first place. Now, this just takes the 5 trading days for last week. It's not Friday to Friday, where we had healthcare, utilities, and staples. These areas have been really down in 2023. They came roaring back a little bit this past week, where you had discretionary that has been one of the stronger areas. It was down the most, where tech, a little bit up for the past week, and communication was slightly up as well. This is where you see a lot of the mega caps. And then going back to the beginning of the year, we still have communication, tech, and discretionary doing the best. All of the other sectors are down. Going back to the all-time high, we have energy, which is doing the best. And then real estate, discretionary, which has been doing good in 2023. It's trying to make up for a lot of the losses it saw in 2022. Looking at sentiment, we're turning more negative now. We're down at 36. So when we look at the historical chart of this, we had become extreme positive, and then we've been working our way lower as we got into the latter part of July and into August. And as we see more of a decrease, people are getting more fearful. And I use the term negative rather than that we're fearful right now. The active asset managers, they tend to do what the market's been doing, where they're actually showing a little bit of a decrease. But please be aware, this is a week old, so this doesn't take into account the weakness that we've seen this past week. Here's another look at that same chart where we drop below 60. We're at 54.33. Looking at the VIX, we saw a real spike up. In fact, on the daily chart in our RSI 9 period, we shot up pretty far, pretty fast after Thursday, and we're getting an extreme reading that way. But we shot up with the line chart as well as the bar chart. Now, that's a pretty big move, but we're still at low levels overall. When you take the static numbers between 12 and 20, we're still below 20 here. We can go a lot higher than where we're at right now. The Ulcer Index is also increasing. On the daily chart, it's crossed above the moving average. Here, it's just climbing. Here's the Ridex Bear Bull ratio. This also does not take into account Friday's decline. We're seeing a little bit of a tick up in fear. Actually, you would expect this to go a little bit higher, but it's just not doing that yet. We had the latest reading of the American Association of Individual Investors. They tend to react to what's already happened in the market, and they're turning more negative. They drop below 0. But this is more positive long term. Now, we're seeing this ticking up right now, but when this is going down, that means tech is outperforming cash. I know that's kind of counterintuitive, but when we ran into some problems in 2022, this black line was really going up. We're declining, and yeah, we're giving some of that back right now, but we haven't switched over to full-blown negative. Looking at the economy, we're having the latest reading of GDP now. It's coming down a little bit, but we still have GDP forecasted at just under 5%. Then when you look at the top 10 and bottom 10 forecasts, we're just a little bit under 4% to the upside and at about 1.5% to the downside. We will get another estimate, the third estimate for GDP this upcoming week. But right now, compared to the other quarters that we're looking at here, this GDP, even though it's a little bit lower, is still looking more positive. But we'll have to see how accurate this ends up being. Looking at the spread between risky and not as risky bonds, if we were really getting fearful right now, we would see this line going up. It's continuing to decline. Then the National Financial Conditions Index. If we were getting into some real problems, we would be going above the black line. We continue to decline. Then these charts, and after this, they haven't been updated for a while. This is just showing how tightening standards have been increased at banks, making it hard to borrow. We have the real-time SOM recession indicator. If we were going to get into some problems, we would be above the red line. We're still down at the black line, but now this is almost a month old, as is the smooth U.S. recession probabilities. We're still down around the black line. The Brave Butters updated a little more soon on September 5th, but this is going up just a little bit. Hopefully pretty soon we'll get an update to this chart. Looking at inflation, we will get the PCE inflation coming out this week. Inflation overall adjusted down a little bit, both between CPI and the PCE. Keeping an eye on the Fed. This is looking out to the November 1st meeting, because we just had the meeting this past week. Right now, there's a 73.7% chance that they will keep rates the same, but we'll have to see how this changes as we get closer to that meeting. They're getting a little more confident here that they're going to keep rates the same, but again, there's a long time between now and that next meeting, so this could really adjust multiple times. The Fed balance sheet continues to decline and has been since June of 2022. We're looking at the change year over year, showing how the Fed balance sheet is declining. Looking at our charts, we're seeing a little bit of weakness here based on price, but we're above the moving average. However, when we look at volume, we're dropping below the moving average. And we're seeing a little bit more weakness based on volume on the daily charts as well. We did see a real expansion of the new lows, and that's causing our 4-week moving average to decline, and our 10-week is also rolling over and going below this red line, which I call the midpoint. The advanced decline ratio, we are declining, but we're still above zero with both the blue line and the red line. Now, this is also more negative. This tries to measure what the smart money is doing. We had been staying above this red line, which is a moving average, but now we're starting to drop below it, and we're turning more negative on the daily charts also. Keeping an eye on our trend. The green line is still on top, but it's declining. The red line is increasing. We are now in a weakening trend because we're below the moving average, but we're still in a trend on the weekly chart. We're possibly seeing a new trend developing on the daily chart, both with the short-term ADX that we look at and the intermediate term, and that trend is negative. Keeping an eye on the rune, not really much of a change here. We're seeing a bit of a decrease in the buyers and sellers, so our oscillator ticked down, but it's still above zero, so that's still positive. The mass index, we're getting a signal on the daily chart. We're not really getting one right here. Watch the daily video, because I try to explain that as we go through this. Some other charts. Here's the daily chart where we closed just a little bit down below this August 2022 high. Please keep in mind that I draw these lines on here. They're not computer generated, so I might be a little off. I'm probably going to extend this trend line, because if we continue to fall, this is a longer term trend going back to the October 2022 low, and we might come down and test this point on the daily charts. Then on the bottom, we can see where we had the big volume update a week ago. Now we're dropping to below average. The trend channel, we're still above the midpoint, even though we're seeing a decline here. When we go all the way back to 2009, and once we hit that resistance in early August and late July, I forget exactly when that was, but we have been having some problems since that time. But when you look at the bigger picture, we're still in an uptrend with our 50-period simple moving average. Even though we're falling back, the red line continues to go up. When we look at the long-term trend, the blue line is still above the red line. Yeah, we're falling down here and showing some weakness, but longer term, the uptrend is still intact. McClellan oscillator, we're starting to get extreme negative. We got extreme negative, and we saw a little bit of a bounce up in the S&P. We're wondering, is this going to go down even further, which it could do, or are we going to get some kind of support at some point and then be able to bounce back up? We're starting to look more negative with the summation index. Now, the summation index is calculated by the McClellan oscillator, and we're dropping below zero based on price, and we're also already below zero and declining based on volume. So this is negative. The Swenlin trading oscillator, we're dropping below zero and declining based on price and volume, and we're not extreme yet. Bullish percent index, seeing almost this exact same chart on the daily version of this, where we dropped below 50 and we're declining. That is negative. The PMO starting to roll over, and we're dropping below zero based on price and volume. Our PMO study starting to get extreme negative with the PMOs that are rising. We're declining with the buy signals, and we're also declining with the PMOs that are above zero. The percent B, we actually had 2 days in a row where the percent B was extreme negative. Here we're just more flat out negative, where we're dropping below the midpoint. All of our oscillators are now starting to turn down, and they're all turned down on the daily charts as well. So that's showing more confirmation on a momentum basis. The chicken money flow, just about ready to go negative. It's much more negative on the daily charts. Chicken oscillator, almost getting extreme negative, but not quite there yet. The force index did drop below zero, and that is turning negative. We're dropping below zero with the money flow index. Actually, we dropped below 50. That's the midpoint. And the rate of change, maybe we kind of overdid it here, but we could continue to go down when we compare this week with last week. And then we were getting an extreme positive reading when we go back 50 weeks with the rate of change. This is starting to come back down. The RSI based on 14 periods, just barely above 50. If we drop below 50, that would turn this negative. Here is the weekly special K chart where we're declining below the red line, which is a moving average. We're still positive on the daily chart, but we are rolling over a bit. The Stochk RSI is extreme negative, and the Williams percent R is also extreme negative. The ultimate oscillator is below 50 and declining. That is negative. The vortex still positive because the green line's on top, but the green line's coming down as the red line's going up. Copy curve is not generating a signal right now, and we're still hanging in there okay as far as our longer term support. Yeah, we had a pretty significant down week, but we're just breaking below the moving average. We still have a lot of other support below where we're currently at. Our different charts turning more negative here with the hike in ASHI. That's black, that's negative. The KG chart, it's a little hard to see, but it's turning red. That is negative. But the Renko chart is still looking positive. And the three-line break, though, is looking more negative. With the ease of movement, we had a down week, so we really declined with the 1 week compared to the previous week. We're starting to drop below zero with the 14 week, so that is turning more negative longer term. We had a couple of new O's posted this last week. That's more negative. We don't have a signal that's being generated right now. Right now, we're just picking this up as weakness. We continue to be negative, actually not continue. We switched over to being negative with the Elder's Impulse system. We went from a blue bar, which is neutral, to a red bar, which is negative. And we're still negative here with the parabolic SAR. We're also seeing this on the daily chart where the dots are on top on each. The PPO studies, longer term, yeah, we're rolling over, but we're still positive. Looking a little bit more negative with the intermediate term, but we're just barely above zero. We're looking more negative in the short term. Some daily charts that you might find interesting. We're watching this trend line from the October 2022 low that I connected to the March 2023 low. We're wondering if we're going to come down to this. This is that same trend line that I was pointing out on the daily chart. The 50-day cycle, we still have a ways to go. We won't be at the end of this cycle until October 11th. Looking at the Dow to transports ratio, it's been chopping around the last few days, but when this is going up, that means the Dow is outperforming the transports, which is typically negative. We're also keeping an eye on the NASDAQ 50% Fibonacci retracement level. We came down here earlier in August and we're able to bounce up off of that. We're not quite at that point yet. Then the NASDAQ 100, we did come down below this S1 level. And we're wondering, are we going to go down and test this previous low that we hit back in August and then finally see some support? Or are we going to turn more negative? We're coming down and dropping below the 100% retracement level on our shorter term fib chart. That goes back to the August 2022 high. And then we're watching a longer term chart where we have a 61.8% retracement level. We're still just a little bit above that, but we're getting mighty close. We closed at 43.20, and I have this marked at 43.13. So we're 7 points above this level currently. But keep in mind that I draw these lines on here, so they may not be exact. Looking at the broad market, where September is the weakest month of the whole year, we're down 4.1% so far. Looking at the different indexes with no studies on them, we're really seeing a lot more weakness in the small caps right now. We saw a bit of a breakdown with the mid caps, and we are seeing some more weakness with the S&P. But the Dow, even though it's seeing some weakness, continues to be in an uptrend. The NASDAQ, weakness, but an uptrend. You're going to hear a lot of the same thing here. NASDAQ 100, weakness, uptrend. Mid caps, weakness, uptrend. This is a little bit more weak because we dropped below the 50-period weekly moving average, which equates to a 200-day moving average. And the small caps, seeing some weakness here, dropping below both moving averages. The NYSE saw some weakness, but we're still above the 50-week moving average. We're still in an uptrend with all stocks, with the 30 biggest software companies dropping down a little bit below the 50-period weekly moving average, but we're still in an uptrend. The FANG index also showing some weakness, but still in an uptrend. ARC came all the way down to the 50-week moving average, but still in an uptrend. The banks, we thought that we were seeing some improvement here, but they got taken lower with everything else. So we're below 50 and declining with the RSI. We're rolling over with the MACD after having been positive. And this is the deposits showing that we're pretty much going sideways now. There was a bit of a decrease in people that are keeping their money in banks. Looking at Dow theory with no studies on here, where the Dow is showing some weakness right now, the transports are showing more weakness. The utilities, which had been showing weakness, which can often be positive for the S&P, well, it got taken down with everything else this past week. Looking at the broad market, the CRB index continues to be in an uptrend on the weekly chart. It's also in an uptrend on the daily chart. Oil, this has been the source of a lot of inflation concerns right now. We're getting above the 90 level. We closed off at the high, but the fact that this is going up is causing concern because of the reason why it's going up, because Saudi Arabia and Russia came out a few weeks back and said they're going to lower the production, and now they're going to lower it until the end of the year, which has been helping oil to go higher. Copper, which is a barometer of the economy, it is looking more negative. The dollar, though, has been looking pretty strong. We're well into the 105 region now. Gold, still having some problems here. Shorter term weakness, still in an uptrend, but it's just not breaking out the way a lot of people think it should. And you can see we have previous high. We almost came up to this level before. And this is really frustrating to people that are very heavily involved in gold, but they can always rationalize that the breakout is just around the corner. Silver also still in an uptrend, but really been chopping sideways. Keeping an eye on bonds. As interest rates are going up, bond prices have been going down, and we are in a downtrend with our total bond ETF. But when you look at a monthly chart, stocks still continue to outperform bonds. We're looking at the 1-month yield and then subtracting the 3-month yield. There's the threat of a government shutdown, and it's pretty much a political ploy that's being floated out there right now. That's why we're watching this, because if we get closer to when the shutdown may actually happen, this could start to go crazy again, just like we saw right before the debt ceiling crisis was solved, or at least dealt with. Here is a daily chart showing how interest rates overall have been going up, but we still have inverted yield curves. Now, this is interesting too, where the UK had been in first place for having the highest rates. The US came back and just crossed above the UK rates as they have been declining. And then German rates have also been going up. We're also seeing an increase in Japanese rates. Some relative studies going back to the beginning of the year, looking at intermarket analysis, where we're crossing down, and oil is now starting to outperform stocks going back to the beginning of the year. Then we have the dollar, then we have gold, and then bonds have been underwater since the beginning of the year. Going back to the beginning of 2022, where we have oil in the lead, then the dollar, then gold, where stocks and bonds continue to be negative. The NASDAQ 100 to the S&P. Yeah, there's some weakness. They both had a bad week this past week, but we're still in an overall uptrend. The S&P 100 is still outperforming the S&P 500. Growth continues to outperform value. Gold is really suffering when compared to the S&P, even though it's going back up slightly here. It's still in a downtrend when you compare the two. And gold is also underperforming the rise in the US dollar. Bonds continue to underperform stocks. The low volatility stocks, we came down and it looked like maybe we put in some kind of a double bottom here. That would not necessarily be positive for stocks because they did well when the stock market was under a lot of pressure. And so if we see a real improvement in the low volatility stocks, that could be negative for the market. Discretionary, though, still continues to outperform staples. And energy has been really bouncing back when compared to tech, but it's still in a longer-term downtrend. Our cyclical and secular and cyclical trend studies. Try to say that fast 3 times. This is longer term. These are seasonality and setups that remain in the background. We still have the signal that was triggered back in October 2022. That is longer term positive and still there. We also have the ZWAG NYSE breadth thrust. which was triggered back in March. We did go extreme negative again. We're seeing some weakness now, but as far as I know, this is still on the books as positive. And the NYSE's, the Horchak method, is still generating a buy signal. And then this is longer term. This is a trend line from the 1987 crash going up to the present day. We're below this trend line right now. This may end up being longer term negative for the market. Here's a shorter term version of that same chart where we've tried to come up to this trend line a few times, but now we're coming back down. We're also seeing the same resistance with the NASDAQ 100, which could be longer term negative. When we look at the NASDAQ 100 and Dow ratio, we didn't quite get up to previous highs, and we're not really falling yet as far as this ratio is concerned, but we want to keep an eye on this one. Now, this is a chart that I found from Game of Trades. They posted it on Twitter, so I thought it was okay to use it here. They have a ratio between the NASDAQ 100 and the Russell 2000, which are the small caps. And when you look at it this way, we're coming back to this previous high. This was the dot-com boom followed by the dot-com bust. But then I went out and made my own chart. Now, I have to do things a little bit different because the Russell 2000 is not the same as it used to be. I took the QQQs to represent the NASDAQ 100 and the IWM to represent the Russell 2000. On this measurement, we're not getting back to that high. So take your pick here. If you're more bearish on things, you think that this spells real trouble. If you're more positive on things, you might want to wait and see if this ratio ends up going higher. Our momentum studies, I only show this for the MACD because on the weekly chart, it continues to be negative. Looking at Tom Valley's research, yes, we are in the latter part of September where we tend to see some weakness. So this is just for Monday's session. Hasn't changed all that much, but be aware of that. We will be dealing with earnings reports. The United Auto Workers strike is still continuing. There was some headway made with the writer's strike having to do with Hollywood, and that pushed up a few stocks. We're wondering if there's going to be a government shutdown soon. And student loan repayments are supposed to be starting at the first part of October. That could be a drain on the economy. Our technicals are negative on the daily charts, and we're starting to see a trend develop, and that trend is negative. We won't get any economic reports on Monday, and we're keeping an eye on the geopolitical events. It's about inflation, interest rates, and what the Fed may come out and say. But any one of these other things on this list could come flying in at any time. Here's the calendar for the upcoming week. We will get some real estate information earlier in the week. We're going to get durable goods on Wednesday, and then we'll get the third estimate for GDP on Thursday. The big one is going to be Friday with the PCE prices. That's the other inflation gauge. Then for September 25th, we're neutral to negative across the board. We're now beyond the options expiration week, so that was negative, and that historically played out the same way this past week. We will be on the 16th trading day of the month where we do see some weakness. We might see a little bit of a bounce later on before we see some more weakness going into the end of September. And here's the Carson chart also showing weakness. Now, the market can do whatever it's going to do. We're just looking at historically what has happened. And then looking at the NASDAQ, where we historically might see some weakness going into the end of September. Here's the S&P also. That's the green line also showing some weakness. And we're only up 33.33% of the time for the month of September, going back to 1950 when you calculate all pre-election years. So our scenarios, you could lean more on the daily version of this to the downside because we're turning more negative, but be aware, we're starting to get oversold in the short term. It's not really there yet to go positive unless you're like super, super risky on things. You could still lean more towards the sideways trend because even though the ADX is showing a new trend is developing, both the short and intermediate term are still below 20. The warning signs based on how things closed on Friday. The longer term trend lines that we were looking at for the S&P and for the NASDAQ 100, they may be signaling that we're at a top because we're having a hard time breaking through those. We're in a seasonally and historically weak month and a weak period within that month. The equity put call ratio is going up. That's negative for stocks. And our longer term equity put call ratio is also going up. We were showing more of a risk on posture. Well, now that's starting to show some more weakness. And we're seeing that more day after day. The S&P 500 daily oscillators are negative, and we're also watching the NASDAQ 100 PPO, which is also a momentum oscillator, they're now turning more negative. The cumulative new highs and new lows for the NASDAQ are still showing weakness, and that goes back quite a while. The 3-month yield where we were at back in 2007, we're still above that level, and we're waiting to see if that's going to roll over, and will that be some kind of a warning sign. The S&P is now underperforming utilities, and the Staples to S&P 500 ratio is going up, which that benefits the S&P when it's going down. The Russell is below its 200-day simple moving average, and we're wondering, is that producing a head and shoulders top? I just got done reading an article that maybe the S&P is producing a head and shoulders top as well. I'm not as convinced, but I will be covering that in Tuesday's video. The parabolic SAR daily chart is negative. The Vortex daily chart is negative, and we're dealing with earnings season. Looking at the positive side, the seasonality and setups that I went through in this video, those are still in the background. The daily special K chart, even though it's rolling over, is still positive. The weekly chart is negative. We're still above the downtrend channel upper line. I haven't been showing that chart. I will show that in the deep dive video. The Russell, the small caps, and the mid caps, even though they're getting hammered right now, they have generated recent golden crosses. Small and mid cap growth continues to be positive, even though it's mostly chopping sideways. The financial sector been getting hammered too. It generated a recent golden cross. So our conclusion, this is just for Monday. We are negative in short term and intermediate term. We are starting to see a trend develop. Now, if you're more aggressive, you're probably already jumping on that trend. But be aware that in the short term, we're becoming more oversold. We've got a long list of indicators that show that we've gone down too far, too fast. Intermediate term, we are more negative, and we have some indicators that are starting to become extreme negative. But for right now, as long as we stay above the 200-day simple moving average, we are still positive. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. I hope you have an excellent weekend, and I will talk to you in the next video.